What's very unique about health insurance brokers, employers who are fully insured, they could go get quotes from 10 different brokers, and those 10 different brokers can go to all the same insurance companies, Blue Cross, United, Cigna, Aetna. We are all going to bring the employer the exact same plans and the exact same premiums.
Welcome to our financial planning overview videos. We're delighted today to have Brian Tolbert and Zach Cole with us, and we'll be doing a series on healthcare financial planning over the next several weeks. We'll be getting into different areas, and we're delighted again to have Brian join us as a benefits practice leader with Gallagher, really looking at the employer and employee benefits. And then we'll dive in with Zach, who is a healthcare financial planning leader and manages a team that we work with to help our clients discern what the best path for healthcare is, particularly with Medicare benefits, but also with employee benefits and other types of things. So we're really excited to have these two experts in this area because it is a very, very complex area, and it is one that requires a tremendous amount of attention with all of the different pieces and moving parts. And so today, we're going to dive in first with Brian, who will help us to understand first the employer's side of selecting benefits plans, and then be able to dive into the employee side of looking at the different coverages and options there. So Brian, again, thanks so much for carving out time to join us today.
You bet. Good to see you all. Thanks for having me.
First, as we kind of put on that employer hat, we do serve clients, of course, that run companies. And as they look at the healthcare landscape and think about how they make choices with health insurance plans, kind of at a high level, where do you start as you work with companies in selecting a plan?
Sure. It's a great question. There's a lot of benchmarking surveys out there that can help employers get a feel for what they need to be providing in order to provide a meaningful benefit and a competitive benefit within their market. The things they're going to look at are going to be deductible levels, out-of-pocket levels, and then certainly payroll deduction pieces. For smaller size employers, say less than 100 employees, I think that information oftentimes is interesting, but it's hard to make it actionable. After all, if the benchmark says that most employers have a $3,000 deductible, but the employer simply can't afford to offer a plan that rich, it's harder to come up with those funds, right? Much larger employers, because the numbers are bigger, you can get more creative on sort of the whole financial wellness of your employees. And so I think the benchmarking is a good place to start from that standpoint. But at the end of the day, it is going to be a budget constraint. When it comes down to the actual plans, we're seeing, the employers in that probably 2 to 100 marketplace. Traditionally, they're going to be fully insured. They're working with Blue Cross or United or Cigna, someone like that. Oftentimes, they're maybe offering their employees a choice of two plans, maybe a base and a buy-up plan. The base typically has a higher deductible or maybe is an HSA eligible health plan. The buy-up plan is going to have that lower deductible with copays. And then as far as contribution strategy, the employer ends up typically paying a percentage of the premiums. Sometimes they'll pay maybe 80% of the cost for the employee-only coverage on that base plan, and then everything else is a buy-up from there. For your larger employers, as you move upstream, 100 plus, this is where employers can get creative with the way they finance healthcare. Sometimes it gets a bad rap, or employers may get a little anxious with the term self-funding. It doesn't mean that you're just on the hook to pay all healthcare costs forever, but it's a different way to structure how you pay for healthcare. You end up leasing a network like United or Cigna or Blue Cross, so employees are familiar with that network and have no issues seeing doctors. But it allows the broker consultant more visibility into the claims. Going back to the interesting and actionable, the decisions that the employer makes around what the benefit is becomes a lot more actionable with that claims data. And so that's typically what we're seeing.
As an employer looks at things just up front and they think about, let's say, that smaller space, that 2 to 100 space, are the plans priced based on the demographics of their workforce, but maybe not the specific issues of the applicants? Is that what we should understand, or is it actually go back to the specific applicants and their health profiles? How do we understand what an employer is really getting into there?
Sure. It's It's a great question. And I'll put some maybe more specific numbers to it. And this is going to vary state by state. So I'll use the state of Tennessee as an example, but this is the majority of them states kind of follow this. The 2 to 50 marketplace, those fully insured plans are merely based on the average age of the employees.
Okay.
So specifically, if you have two employers that are across the street from one another and they each have 30 employees, and the average age of that workforce on both sides of the street is 40, but on one side of the street, all of those employees are cancer survivors, and then on the other side of the street, they're all marathon runners. If they pick the exact same plan from United Healthcare, their premium is going to be the exact same.
Oh, wow.
This is an Affordable Care Act. Part of the law is these small group plans. I mean, these plans are pooled, and so on the plus side, you do get that consistent year over year premium. It's based on the pool. It's based on average age. But when you're fully insured, if you've got a very healthy workforce, you're not going to get credit for having a low claims year. 51 to 100, as you move up market, you're still pooled with employers, but health status and claims history does play into account for what your future renewals are.
How do employers look at that dental and vision side of things? Is that something that we're looking and we're starting at a benchmark analysis as well? Or what are the basic considerations there? What are the different paths that some employers will go in that front?
The dental and vision, and if I could extend it, more and more employers are wanting to offer employer-paid life insurance, voluntary life insurance, short-term disability, long-term disability, and then you can move all the way into the accident, critical illness, cancer, getting the best talent, keeping the best talent. Employee benefits is becoming more and more critical. And so what we have seen is whether you have 30 employees or 300 employees, on some level, you do feel like you're competing with employers that have 3,000 employees. And so the employers, for the most part, are wanting to offer as many of these benefits as they can, whether they can afford it or not. And so typically what they're trying to do is they're offering these benefits on a voluntary basis. And then what the actual plan itself is less of a consideration. It's just more of a matter of whether or not we're able to offer it or not.
As employers are looking at the landscape and they're trying to figure out, okay, who do we work with here? What should they be thinking about in terms of selecting a brokerage firm?
What's very unique about health insurance brokers in this market, and I'm going to stick with the under 100 and then I'll move up market, but employers who are fully insured, they could go get quotes from 10 different brokers, and those 10 different brokers can go to all the same insurance companies: Blue Cross, United, Cigna, Aetna. We are all going to bring the employer the exact same plans and the exact same premiums, which is sort of bizarre. Most employers are they're typically used to sort of going to market or going out to RFP for every other part of their business. And certainly property casualty insurance, there's value to having two brokers go quote for you, because I could have a different contract or I could have access to an insurance company that my competitor does not. With health insurance, that is not the case. The insurance companies, they file their rates on a quarterly basis with the Department of Insurance within their state. The commissions are built in, what the plans are, the deductibles, so forth and so on. They're all the same. And so ultimately, the employer is buying a product off the shelf, and they're using their broker as a way to communicate, explain it, support with claims and billing, and then additional resources around HR support or benefits technology. So typically the differentiator is going to be around those additional services that the broker offers. It should not be a decision based on, can you get me a lower price? Now, as you go up market, because there are different ways that you can finance healthcare and you can go self-funded, the broker and the advisor can start to get a lot more creative. And that's where, while two different brokers may have access to the same markets, the approach that the broker takes on bringing some of those ideas to the employer, that is going to be very unique. And so I think there is a lot of value in maybe talking to different brokers each year as you go up market.
Well, super. Well, I think that gives us, a helpful understanding of small business owners, what they need to be looking at, how they need to kind of approach this, from that first engagement, with a broker. And of course, you at Gallagher have just, a wide array of resources, big firm, and a lot of technology that you bring into that space, I know, to be able to help, with those smaller employers, 100 and south, be able to make their operations more efficient. So again, appreciate you filling us in and giving us context there. Anything that you would say in terms of where you see maybe folks get tripped up, the biggest mistake that you might see employers make as we kind of round out this portion of our conversation?
Maybe lack of engagement. I think oftentimes employers forget that this is the third highest line item, maybe the fourth highest line item on their P&L. It's going up 12 to 15% every single year. It's not their fault. I kind of joke, high schools failed us. They should have talked to us about mortgages and taxes and credit scores and insurance. Like that's where we should have learned this stuff. But they didn't. And as a result, people don't have the vocabulary to sort of articulate what their problem is, what the challenge is. And so if they get a favorable renewal, they sign it quickly and just move on. When really that's the year that you could probably do something more creative to drive down costs in the future. And so I think that the biggest issue is just lack of engagement to try and bend the cost curve back in the employer's favor.
Well, thanks again for this section of the conversation, and we'll look forward to engaging here more on our next episode.
Great. Thank you.
If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.